Hey mates, today we're talking about one of my very favourite topics, and it's the stock market. So what I'm going to do is break down 10 things I wish I had known before I invested in my first stock. So let's get started. I hope I've caught you before you've bought your first stock, so you'll be a bit more prepared than I was. The first question: what exactly is a stock? What a stock is very important to understand, because if you understand this, you can make much better decisions. So, what a stock is: when a company like Apple or Facebook decides to go public, they offer common shares to the public. What this offering looks like is an initial public offering, or an IPO. The company decides how many shares they're going to give out to the public. So let's just say 1 million shares. And they determine at what price they want to offer the stock. Now, there's lots of strategy and thinking and calculations to go into this. And now you and I, the public, can go and buy these shares. You are buying shares of a company. Which leads me to my next question. Why would I want to invest in a stock? Very good question indeed. So let's get into it. What happens when you buy a stock? A good stock is you invest capital, that your hard-earned money, into this stock, okay? And over time, as that company grows and gets more earnings as they release new products, you are able to grow with them without doing anything. You pushed a button on a computer, and now your capital, your hard-earned money, is working for you. And that is smart. And that is what the wealthy do. Question number 3. Why do stocks go up and down? So, a fascinating question. There are lots of answers. However, keeping it simple, as we talked about, a stock has a finite amount of shares in the beginning. So what happens is we create this economic phenomenon. The easiest way to understand why a stock will move, go up or go down, is economic principles. If we have a finite amount of shares, as we've discussed, we already have, that is supply. Supply is consistent or going down as more people buy those shares up. Think about stocks as a marketplace, okay? So every time someone buys a stock, someone must sell one to fill that position. The stock is going to go up naturally based off of economic principles. The stock will plummet if bad news comes out. There is going to be an opposite movement downward if the sentiment is negative. Supply is going to go up as more people sell the shares, and demand for that product goes down. It's all economics. It's logical if you think about it. Number 4. What does it look like to own a stock? When you purchase your first stock, it's going to show up on whatever trading platform you use as a ticker. So what that means, you've heard me say before, Facebook, FB, Apple, APPL. You buy Facebook, okay? You now own that stock. It will show up on your purchased stocks on your platform, and you can track its movement. So you bought Facebook, let's just say, at $170, and the next day you bought 10 shares. The next day it goes up $2 to $172. You have made $2 off of 10 shares, which is $20 overnight. You've made that doing nothing, and that is passive income, portfolio income. It's smart. And as you get more capital, you can buy more shares and make a larger impact on your portfolio. This is fun stuff. Number 5, I wish I had known before I invested in the market, is this idea of a bull market versus a bear market. So it's very simple, actually. We've been in a bull market for the last 12 years. What that means is stocks have consistently gone up. There is very positive sentiment in Wall Street. Everyone is purchasing. Companies are buying back shares of their stocks, which is great for their stocks, bad for their debt. But what happens is we keep going up, 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 up. We've seen it this February. Something bad can happen and can trigger a switch into a bear market, where we are currently in a bear market. A bear market is technically a decline from 20% of a bull market's high. As the market dropped and dropped and dropped during the outbreak, once it declined 20% from the high, we have reached into a bear market, and Wall Street's sentiment changed drastically. Bear markets generally last about 6 months to a year and a half. They can last longer, they can be shorter, and bull markets tend to be longer and less severe. They go up, up, up steady, where bear markets are very harsh, very steep, which is why they are oftentimes a bit shorter. Good investors make money on both a bear and a bull market. Number 6, what is a dividend? Now, I know I covered this briefly in another video or short, but I want to get into it again. A dividend is a company's way of giving back to the shareholders, the common shareholders of a company, by saying, we have extra profit in this quarter and we want to distribute it to everyone who has helped us grow and has faith in us. If a company has a dividend, this is generally a very good sign that a company is profitable and has very strong financials and good management who knows what to do with the money. I like to invest in companies that have long-term dividends, because what that means is a company is very smart with the money. They have a good product or service that is profitable, and that's what we're looking for, and they take care of the stockholders of the company. Those are all very good things. Look for strong dividends. Also look for strong dividend yields, and what that is the dividend payout. So if we have a dividend of $1.25 per share and the stock price is at $60, it's 1.25 divided by 60, which means we have a dividend yield of 2.08%, which is fairly strong. If you own 100 shares of that stock, 1.25 times 100, you'll make $125 per quarter. Dividends are generally paid 3 times per year. So you make $375 per year just owning that stock, and you can choose if you want to keep that into your portfolio or reinvest it into the stock. They look at dividends. They're a great way to build your wealth and buy secure companies. I love dividends. Number 7, I wish that I had understood earnings season a bit more. There's all this hype around earnings seasons. What is it? What it is each stock presents its earnings because they are publicly traded companies. They must tell us stockholders about their financials, and they do this quarterly. They do it 4 times per year, and it's an exciting time on Wall Street because the experts provide estimates and what they think these earnings will look like. And if the company beats those earning expectations, there's oftentimes a lot of movement up. If they miss on these earnings, there's generally a decline in the stock price. Sometimes, no matter what, it goes up or down, and the people taking profits, it's Wall Street, it can be a bit crazy. At the end of the day, earning seasons are very good times to look at stocks you think are undervalued and watch as people flow into them as good news or bad news come. Check out earning seasons. Now, the first thing I want to talk about, I don't want to confuse you, but there are 2 markets in the US that we're going to focus on. The New York Stock Exchange, which you've seen images of. There's a trading floor with moving pots and people yelling and tickets being thrown and people pointing. That is the New York Stock Exchange, and then there's the NASDAQ. The NASDAQ is a bit newer of a platform, and there's no actual trading floor for it. What happens in the NASDAQ is large tech giants are traded. It's just a different marketplace with slightly different fundamentals, but they're two very large trading platforms that operate in the US. Question number 8 to cover is what's the difference between the S&P 500, the Dow Jones Industrial, and the NASDAQ? So what are these things? It's very important to understand them. So these are called indexes. You can invest in indexes. So you could buy shares of the S&P 500 and you're being diversified just by being in the S&P 500. You're not buying Apple, you're buying a group of stocks. The Dow Jones is the 30 largest, richest companies in all sectors except for utilities and transportation. It's generally used as an indicator of the broader markets. The S&P 500 is very interesting. It's just a jumble of the 500 largest businesses in the US. So great companies are strong and they've performed very well in the past. Love it. The NASDAQ is a group of tech giants. Very techy indeed. But the NASDAQ has done very well. It's a newer index and it has performed handsomely. Number 9 that I wish I had known. Why doesn't everyone invest in penny stocks if you can get rich so quick? Because not everyone is good at it. Penny stocks are very, very volatile beasts. They have the tendency to move up and down very quickly because they are small cap investments with less overall shares, less supply, and demand can spike and go down very quickly, which means the stock can be very volatile. Volatility is just movement in either direction, sharp movement, and that can be dangerous. For a new investor has a hard time understanding these stocks and they might trade emotionally if they're not prepared for these penny stocks, so beware. Also, penny stocks have the tendency to do this thing called reverse split. I can do a separate video on the reverse split because it's a dangerous beast, but it generally only happens with small cap penny stocks that need to stay at a certain level to stay listed on that index. Number 10. What is day trading and the rules around day trading? This is a huge topic. A lot of smart investors make a lot of money by day trading. But there are some rules we must follow if we are day trading. When the stock market opens at 9:30 a.m. Eastern Time, let's say you buy a stock right at the open, you buy Facebook. The stock goes up, 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 up. You've made lots of money in the day. You timed it perfect. The world is great. But you think that bad news might come out overnight, and you don't want to risk holding that stock overnight, so you sell it the same day. You sell it at 3 p.m. That is considered a day trade. If you day trade 3 times within 5 trading days, you'll be flagged. Okay, and what happens when you are flagged is you essentially cannot trade any stocks. It's not good to get flagged. You don't want to be flagged. So I would recommend at least waiting 1 day to sell if you can. And if you have to sell, you've made a bad decision or you just want to take your profits, don't do it often. I've only done it once. And it was because I was watching the stock and some news came out right after I purchased it. And I said, I don't want to hold this stock overnight, okay? Be careful day trading. One more note on day trading. If your account has a balance over $25,000 in it, you can do unlimited day trading. That is how good day traders perform. And until we get to that point, I would say don't try day trading. Let's learn a bit more first. I have ideas of my next video. I'm going to show you 5 resources to start trading like an expert on Wall Street. It's going to be fun. Thanks for joining and good luck trading. Tick Giant.